All right, welcome to Yahoo Finance's morning brief on this Tuesday, March 24th. I am Miles Udland. That is Josh Schaefer, newsletter editor over at Barron's. Julie Hyman in Houston on assignment. Let's take a look at where futures are trading here, about a half hour until the open on this Tuesday. And we're lower, down about 0.6%. We sat here yesterday, Josh, and the last thing I asked you with the market, or futures at that point up about 2%, I said, would the market close on Monday green or red? And you said red. Now, the market was up about 1.5% yesterday, but you were telling me just before we started that actually you were right. If you would like to share that with the class on why you were correct that it was a red close when the S&P gained 1.2% yesterday.
So I was wrong, of course. But I think really what I was getting at, Miles, was I wouldn't have been a buyer at the open yesterday or really a buyer throughout the day. I felt like there was a good chance stocks were going to close at their lows of the day, which they eventually did. And if you watch sort of the rally that was throughout the day, it just was kind of a casual move lower throughout most of the session. And I think you're seeing that reflected in futures right now, which is basically, I would define this market right now as sort of a, what do we do? What do we do market? Maybe a do nothing market. It seems like there's not a lot of trust in the headlines that we actually got yesterday morning that this escalation is fully over, that the war is winding down. And so I think when you sit back as an investor, like how much did, which we talked about really for almost all of 25 minutes yesterday, but how much did the story change from Friday to Monday? And I think the longer it settles in, investors are kind of deciding maybe the story hasn't changed that much yet. And that's sort of where we sit here from at least how I feel from my seat on Tuesday morning.
You know, I think you should have leaned into that a little bit more. I think you could have taken more credit or spun it a little more tightly that you were right. Because, well, it's like, okay, it's a do nothing market. I think it's a little bit worse than that. I mean, again, when we were chatting on Friday and over the weekend about like, okay, what are we going to do Monday, Tuesday? The kind of meta question was like, are we bearish enough?
Yeah.
And we both were like, probably not. Right? And now again, the S&P is what, 7% off all-time highs? Like we haven't taken that big of a dip. Things look a little bit more constructive than they did on Friday. We were sitting here yesterday talking about the 200-day moving average. That seems like a little bit less. Well, I mean, we're still right in that ballpark. So that still kind of is the battle line. But as you mentioned, that fade all day yesterday, people did do something. They decided to not continue, following through with whatever, whatever buying signals are coming in earlier in the day. And so it does feel like there's a general lack of enthusiasm for the overall market. And I'm not 100% convinced that all of that is geopolitical. I think one thing that I was looking at that, was like, okay, what are the possible like triggers or things people are looking at we haven't discussed yet, which is calendar. We're a week out from the end of the first quarter, and now we can get into like real Jared Blickery territory around flows and squaring up portfolios and just like, what do you want? When you're closing out your statements, you're an institutional investor for Q1, what do you want a couple things to look like? Your returns, which you can't fully control, but you can window dress or try to manage some of that. And then 2, what is actually in the portfolio at that point in time. And then 3, what's the leverage or what's the gross, let's say, right? Are you 105% long? Are you 99% long? Do you want to go from 130 long to 110? I mean, this is sort of very like insular stuff for investment decisions, but I think that all these factors in what's been a pretty messy start to the year are why we see a lot of headlines and none of them feels like the answer yet, because there's a lot of money management problems, I guess I would say.
Well, so would you take that then? So we're going to be down for the quarter, right? That for
most likely
for the first quarter, you're probably going to be down.
Yep.
I would wonder.
Or the index is going to be down. Yeah.
The index is probably going to be down. So I would wonder if it's a sell your losers into the end of the quarter. Then is that sort of what you're getting at to some extent?
Well, you could do it a couple ways, right? You could sell the losers. I mean, I don't want to go into all the particulars of like, the tax, is it an SMA or is it, all the fund, all this stuff. I think it's just like, again, if you're going to offer an update on where you stand at the end of the quarter, what do you want to be in that? So do you want to say, like, we came in with a view that the market was going to do this in January and we were surprised by that? Do you want to send that letter out, mid-April and say, well, geopolitical events overtook our strategy? Do you want to say, actually, we doubled down on software because we're super excited about, kind of the way that these companies, the way the winners in software can leverage AI going forward? I think this is a great value. Like, those are you're reverse engineering what you want to communicate to your investors. But I think a lot of that is going to lead to folks looking around today, tomorrow, through the next several days, and just trying to think like, how, if at all, do I need to change the portfolio near term? And then that gets to some of the winners or losers, and that I think shapes the market action as much as the next incremental headline on what's happening in Iran.
Can I give you my pitch for why I think stocks are going to close the week lower now?
Okay, there you go.
Yeah,
Great.
So
Great.
I won't be here on Friday.
Okay.
I won't be here on Friday.
So let's do the math. We were up about 1.2% yesterday. We're down another 0.6 today. So we're slightly positive for the week so far. So you've got 4 days to make this case.
Yes. So essentially my point was, we were talking around catalysts, right? And so like what makes this sort of...
Coming up at 10 o'clock.
We're feeling a little bearish. What flips that? How do you get buyers back into the market here?
Yep.
And one thing we've talked about a lot over the last couple of years, and I wrote about a lot in my time here and writing in the morning brief, is Michael Kantrowitz has this thing that he always talks about with, if there's a big catalyst that starts your correction, you need the catalyst to reverse, right? And the catalyst we've all been talking about for the past couple of weeks is oil. And so if you're going to tell me that something takes Brent from going down a little bit one day and then Brent's back up above 100 this morning, right? Or I think at last check.
That's right around 100 right now.
Yeah. Yep. And same with WTI, right? You had WTI touch almost 85, I think, at one point yesterday, and then it gets back above 90. What actually sustainably brings that down is obviously, I mean, we don't need to get into the geopolitics of it all again, right? But you need that to really come off the boil here. And does that happen in the next 3 days? At this point, I'm just saying no. Like, I don't know what brings that down instantly. Yesterday, we had a chance at it, right? You had oil, both forms of oil down 11, 12%. And it was like, okay, here we go. Maybe here's the unwind. It didn't happen. It caught a bid off the bottom, and it's still hovering at levels that make people uncomfortable. And I think until you get rid of that headwind and people feel confident in that headwind, I think your direction is lower.
So that brings us to the Fed. We have a story this morning from Jen Schomburger, who covers the Fed here at Yahoo Finance, talking about how the Fed has and hasn't reacted to oil shocks in the past. And I think it complements your point well. And now, obviously, we had the meeting last week. We're not going to get a Fed meeting until the first week of May. So there's a little bit of a lag here in terms of when the Fed could act next. But it comes to this idea of the Fed's likely not going to be the catalyst to react aggressively against the rise in oil. And it feels like the geopolitics of what sent oil to 100, maybe it doesn't send it to 150, but coming back to $70 a barrel on WTI feels pretty far off right now. And so it feels, just to add to your point, that not just that catalyst, but what would be the trigger to start getting markets interested in there being a turn, in that, again, that main source of pressure in the stock market.
Yeah, well, and she quotes Waller in that story, right? And one thing that Waller pointed out was, he says, quote, if it's at a very high level and it stays high for months on end, then at some point it bleeds through because oil is an input, et cetera. But that's sort of the question I think we're debating here is, first of all, is 100 on Brent and 90 on WTI too high? I don't know. I'm not an economist. We could go talk to one and come back with a better answer. But it's certainly not 70, right? It's not 80. It's higher than it was. And so if we're just continuously sitting there, that seems to be an area that has been an issue for the Fed in the past, right? If you just sit at an elevated level, they just sort of completely turn into wait and see mode. And it's like, well, we'll see what happens here, which I think is, at least at this point, what you're looking at for the Fed for the next 6 months, right? Unless the labor market fully deteriorates, you clearly have inflation that is going to trend higher for a couple months here. You're not cutting in June into that. If you just have pure data that's sending inflation higher, I don't think you can cut in June. And then to your point of, we don't have the Fed put, the Fed's not coming to help you, it just doesn't help the markets.
Well, and then, I mean, let's just stay on the Fed as well, because as the dust settled on last week, it's now we're like, oh, Kevin Warsh might not actually be the Fed chair come June, to use your point, because as soon as you said they're not going to cut in June, I'm like, well, Kevin Warsh might be the Fed chair. Maybe you get some consensus around that. But now as time kind of drags on and it looks like there's going to be some resolution, in Congress around the shutdown, fixed TSA, right? So there's a little bit of movement going on there, but we still don't have a hearing scheduled, for Warsh. And we had Henrietta Treyz on yesterday talking about how the Senate for anything, and this, I asked her about the funding bill for the war, but she's like, listen, they've got 90 days to do anything, and then it's campaign season. So all this to say, there's not right now, I mean, there's a clear path to Kevin Warsh becoming the Fed chair, but there's a procedural challenge, it would seem, sitting here today on March 24th, for him getting in that seat by June, which further complicates the question for the Fed, because not only may you have this, might you have this inflation problem, but now you're going to have a markets challenge of the market trying to understand, what does the Warsh Fed look like? What does the Warsh block look like?
Is Powell on the Warsh Fed?
Well, Powell's almost
still there?
Well, he said until there's a full resolution to the legal challenge, he will remain on the Fed board.
Right.
But to bring up Chris Waller, Fed governor, Fed vice chair, he did not dissent on the decision to hold. He had been dissenting. So now it looks a little bit less like there's a Warsh block, let's say, and you have, I don't want to say it's a normal Fed, but it's just a group of individuals who are making their judgments and voting based on what they think is best for the economy, a little bit different than what it felt like we were careening towards maybe 3 or 4 months ago, where it's like, no, you're going to have kind of look like more like SCOTUS, right? Where you're going to have like the block, these 4 governors are always going to vote.
Voting where.
Right, and it feels like that Fed has also changed. So all these factors on the margins are just negative for like what makes stocks go up. Lower rates. What helps stocks to go up? Lower oil. I'm looking around, not seeing where this is going to really come into play.
Yeah, well, you brought up what I think was one of my bigger takeaways from the Fed meeting. We always sit there and debate, like you're watching markets as you're listening to Powell. What comment did he make that sort of sent things down? And it was really when he started not answering questions, and he just gave his answers because he was expecting more questions on his future and the future of the Fed. That was when markets really turned last Wednesday. And so I think there was, I wrote about this in our Substack. I got to bump it at least once while I'm here, right, for 2 days. Searching for signals on Substack, check it out. But I wrote about Neil Dutta's point on good news cuts being gone, right? Yeah. And maybe you're not going to get a cut just simply because of the soft landing narrative, and that's trouble for stocks. And I do think that's trouble. I think the general uncertainty that you just laid out there was also the biggest trouble for investors. Like, what's going on down there?
Yeah.
Do I have any confidence in who's running the Fed in a couple months, what the path is going to be? It just, like, once you start having meetings where you come out and the press conference, one of the key quotes is, we basically could have not done a dot plot because we don't really know what's happening.
Yeah.
I don't have a lot of confidence in that, right? So it's hard to invest around, and that makes me say, man, maybe I'm good right now.
Well, and I think that, this gets to a meta question. I think that comes up all the time, frankly, which is like, why does everyone care about the Fed so much?
Sure.
Like, who really cares? There's a bunch of guys sitting around and women sitting around like talking about what's monetary policy? Sure. But the modern market is very locked into rates as a lever for, do I want to buy on the margin, or do I want to sell on the margin? And all else equal, lower rates good for stocks, higher rates more challenging for stocks. Doesn't have to be bad, just more challenging. And so the reason why investors in this market are so locked in on the Fed is because they just want to know, what's the next move? And to your point, this is like on the street. Why do we care about the Fed? Well, markets want to know what happens next, and now we have as little certainty about the next move for the Fed as we've had in some time. Therefore, you have a major problem, I guess you would say, for the market in trying to figure out, what's my move here? What's my bid?
And a final point on this, and we can pivot or we can not.
We'll move on.
I think there's a recency bias aspect to this too, right? When you think back to 2022, when is the last time stocks really didn't work and we had a big down year? The Fed was raising rates, right? And so now that you have markets even debating that, whether that's actually going to happen or not, I think is a whole separate question. But you have market pricing starting to consider the possibility of raising interest rates. And I think if you think just from a recent experience in these markets, that was the last time being in stocks really didn't work, right? So if I'm even considering the possibility that the Fed's next move could be higher, that makes me nervous as an investor.
Yeah. All right. Speaking of markets, but not the stock market.
Sure.
When I came back to Yahoo Finance 2022, when you were just a young cub reporter, you were on the sports business beat, which was really kind of the sports betting beat.
Sure.
Daily fantasy beat. We saw DraftKings and then Flutter both. Had they been public at that point?
DraftKings had been public. Flutter was public in Europe and then came to
Flutter, parent company of FanDuel.
Yes.
So now we have publicly traded companies, sports betting, and of course the insertion of prediction markets has been the big thing in the last couple of years. The influx of cash that has gone into Kalshi and Polymarket, I'll disclose, Yahoo Finance has a partnership with them. The influx of investor cash into those two companies in the last year has really made the prediction market, I guess you would say it's a problem for the sports betting companies at the very minimum. Robinhood is now in this space. Coinbase is kind of rushing in. It's all kind of one market at this point. And yesterday, very interesting series of developments where we saw in the morning it reported that there's a bipartisan push in the Senate for rules to, or legislation to create further rules, insider trading rules, essentially, around who can bet on Kalshi and who can bet on Polymarket. Both companies really quickly came out and said, we now have new rules on who can bet on our platforms. And I'm just wondering from your perspective, let's start from the business side of how you've thought about the way these two players have changed both the sports betting market and the way that we've seen, I think, Robinhood, Coinbase, a lot of others rush in to make this like one big macro bet on everything all in one place trade.
Yeah, so I think if you talk to the gambling companies over the last couple of years, and I remember Peter Jackson telling me this, I think it was 2024, it was during the election. I asked him a sort of a throwaway question at the time as a last interview question. I said, would you allow betting on the presidential election if it became legal here? And he said, yeah, we're interested in that because they do it in Europe. Like Flutter is a international brand, right, that has experience in different kinds of markets. So they were always interested in it. I think the twist here has been the prediction market companies, Kalshi and Polymarket's ability to get into sports gambling in states where sports gambling wasn't legal. And like we can call it prediction market sports betting or whatever, but like it's sports gambling.
Not a bet.
Right?
It's prediction market on a sporting event or whatever the exact terminology would be.
It's sports gambling, right? And
I'm in a legal state, so I don't know how they thread the needle. Yeah.
But now they're pushing into states where it wasn't legal. Yeah. And so if you think about the total TAM of what the eventual pitch was for all of these sports books was, well, yeah, think about how well they're doing now. They haven't even gotten in California yet. They haven't gotten in Texas yet. Maybe they eventually turn the story around in Florida. Then they have those giant states with all these people, and then you're talking about a totally different sort of overall market, right? Well, if you have two companies that go in, one thing that's been true with sports gambling since it was legalized almost a decade ago now, the incumbents usually win. Like DraftKings and FanDuel in the beginning, it was like, oh no, ESPN's getting into this. MGM wants to get into this now. Penn Entertainment's going to get into it. And all of these, Fanatics is going to get into it. Well, guess what? The companies that were there first just won. Because once you have it on your phone and you already have your money logged in and the thing works, you just stick with it. And so I think that's been the real threat for these companies is Kalshi and Polymarket move first to get the CFTC approval to just do essentially sports gambling in states where it wasn't legal. And then it's like, oh no, can FanDuel and DraftKings really come in second here? How much would they have to spend to get someone to move off Polymarket or Kalshi? And then are you back in that sort of promotion standpoint where they're giving away free bets? So I think that was the concern.
Yeah, I mean, look, to that last point, you kind of never, like it's kind of become clear you never really leave that space if you're a gambling company. Like they still are aggressively promoting, all kinds of new customer offers are just constantly, part of that equation. The thing that I'm trying to work out, and maybe it's not the right comparison, but like the two models I have in my head here of how the prediction market thing plays out is, does this more represent the daily fantasy arc? So the daily fantasy arc was, all these companies, many of these companies, created daily fantasy games that were not sports betting, but they kind of like got around the rules. It had a sports bet cadence because it was quicker, right? Because a fantasy league is the whole season. So daily fantasy is like a one-time event. You pick your team, blah, blah, blah. We don't need to explain the mechanics. So, but that arc eventually led essentially to sports betting. Same platforms, right? We're the leaders in daily fantasy. Or does it have a more crypto adjacent arc, which is, this is, yes, there's gambling aspects, let's say, YOLO aspects still to the crypto trade, but that was like a big part of it 5-7 years ago. And then it just became institutionalized as we would sit here and discuss crypto allocations in the same way we do, the way we discuss fixed income and equities within investment portfolios, right? So I'm not sure if that's quite the right comparison, but I feel like the way prediction markets came on the scene so quickly, how they ramped, how they infiltrated these user bases, I'm trying to figure out is it which one it is, but maybe this is just totally not on the mark here.
I mean, right now it's more the daily fantasy route, right? Because in order for it to be crypto, and we start talking about allocations or serious players are going to start allocating money to there, right? I would want to hear more interest from people that I speak with, which usually ends up being an off the record or on background question. But I have asked investors and banks are you guys interested in this?
Yeah.
Do clients want to put money in? It's a more binary bet, right? Rather than we're going to position X, Y, and Z the other way because we think the jobs report's going to come out a certain outcome.
Yeah.
One could argue, if you feel strongly about your forecast, you could just go and place a binary bet on how many payrolls there's going to be, or a binary bet on where the unemployment rate's going to be in 3 months.
What's the answer?
And that could be, they said right now, no. They're using it to track how markets are pricing things, and that's more of a volume story. If there's high volume in a market, then they feel like it is
That's
worth
a stronger
actually,
market, yeah.
Then it's a stronger market, and it is giving you some sort of read.
Yeah.
But they're not looking to actually allocate money in those places.
Yep.
And then, yeah, I don't know. I think the daily fantasy part of it just sort of means that we're at a nascent part of this, right? Okay, people want to bet on random things on a prediction market.
Yep.
Kind of go for it, and we'll see how real it gets.
Yep.
I think FanDuel and DraftKings still survive out of this. FanDuel's down 50% just to start the year, or Flutter, sorry, is down 50% to start the year.
Yep.
I think that's a viable dip at this point because I think they're different products. That's still a sports gambling product that works.
So we'll just close the loop here on what the actual companies came out and said. Polymarket announcing new rules for its trading platform. So it's now got 3 categories of prohibited insider trades: trading on stolen information, so that's basic one. Trading on illegal tips, okay. And then the most interesting one is trading by those who can influence the outcome. Now, the way that Kalshi framed this in their announcement was they're going to prohibit trading from any person who has access or is in a position to access an MPI, okay, fine, affiliate, source, the agency, or a decision maker, direct or indirect, who has any influence, direct or indirect, on the outcome of the underlying event. So this is really politicians, athletes, guy on the set of a movie where there's a polymarket bet. Like, these are the kinds of things they're going for.
But like, what about the athlete's sibling? Right?
That person is going to be, in my opinion, in violation of employer affiliate of a source agency for any contract. And so if you know the athlete in a personal capacity, I think you might qualify as source agency for a source of a contract. If it's like something like, you know, Josh Schaefer's total in the men's basketball league tonight.
Right. Yeah. And then,
under, by the way.
Yeah, under, right? Yeah. But that would be how you would game it too, right? You would always do the under on something like that because the person can actually control it.
Yeah.
But I just don't, look, it's nice. That's a great idea. I'm just not buying that actually is going to work in practice, right? And they're going to be able to.
I think it's going to work in practice. I think it just, all of a sudden, these are different kind of, like, overnight, they're like different products, I think, than what it was a month ago. I mean, obviously, because there's new rules, but I just feel like this is a grind of new rulemaking in this crypto kind of adjacent thing. Like, oh, well, we want to set the terms. We want to engage with regulators to create the right solution.
It's exactly like crypto.
Like
it's exactly like crypto in that way, right?
Yeah.
Where it's, well, we want regulation. We want it. And then that will take a hard heel turn at some point because you're not actually in control of what the regulation is going to be.
Yeah.
And then you're going to have to deal with it. And then you're going to have probably, I mean, this just looks like it's going to create a lot of PR nightmares, right? People are.
It's already, created plenty.
Right. Do people want to be in that market though?
Yeah.
If all the reports start coming out that there clearly is insider trading, like, I don't know. I don't want to play if it's.
Well, people you're asking can only be in the market if there's rules. So maybe there's the way in for them. All right, futures are lower. Red or green close today, Josh?
I'll take red.
You'll take red.
Today.
Okay.
I'll be bearish every day.
I'm an impartial journalist. I have no view on that. All right, Josh Schaefer, thanks for stopping by. We'll see you next week.
Yeah.
And that'll do it for Morning Brief here on Yahoo Finance. Much more ahead coming up right after the break.
It's Tuesday morning for the investing world. I'm Yahoo Finance executive editor Brian Sozzi coming to you live from our New York City headquarters. Here's what's on my mind right now. First, city strategists are not ruling out $200 oil if the U.S. war on Iran persists until June. Nothing like scaring the hell out of investors with this one. Thank you, Citi. Actually, no. I do not thank you for trying to scare everyone. Second, Goldman Sachs is out calling for a worldwide inflation surge because oil prices have surged on the back of the war. This makes more sense to me than a $200 oil prediction. 3, shout out Admiral James Stavridis, now a vice chairman at Carlyle Group. Here's what the Admiral has to say this morning in his newsletter. Love reading his newsletter. At the moment, there are 2 clocks ticking on the battlefield. The first is the growing antipathy to the war in the United States, coupled with soaring gasoline prices and an initial Pentagon bill for $200 billion. Those costs and declining ammunition levels are another part of the clock ticking that Washington is hearing more clearly each day. With midterms coming in November, the Trump administration is keenly aware of the political need for an off-ramp soon. The second clock ticking is in Tehran, where the regime's goal at this point is simple: to survive. Love me some blunt analysis. And lastly, yes, Nvidia's stock is still trading below the important 200-day moving average. The only 2 Mag 7 members trading above the 200-day, Google and Tesla. That's what we call news you can use. Here on the Opening Bid Roundtable, Art Hogan, B. Riley Wealth Chief Market Strategist, and Yahoo Finance Senior Reporter Inez Ferre. Inez, coming to you here again, like I did yesterday. We are rinsing and repeating. Give me the latest on oil, because the past 24 hours have been absolutely wild.
100%. We are seeing now oil futures up more than 4% after yesterday they had gone down around 10%. Iran saying that they have no intention of negotiating. You also have the Wall Street Journal that's saying that perhaps Saudi Arabia and the UAE could get into this conflict as well. So that would add another layer of escalation. And then you also have attacks that are still happening, a pipe in Iran, gas pipe in southwestern Iran. So these markets are really moving on the headlines. Rebecca Babin from CIBC, she told me, look, the downside when it comes to price movements like we saw yesterday, oil price plunging, she said that is capped, because really there still is so much uncertainty over the Strait of Hormuz and when that will be reopened. If you take a look at Polymarket is saying a 37% chance that the traffic would return back to normal by the end of April. But as you mentioned, Sozzi, you still have Wall Street that is predicting that the longer that this goes, the higher the prices for crude that could go. So Citi, $200 barrel, yes, through June if this continues.
All right, are you a big buyer in $200 oil? I mean, if that happens, GDP is, we're in a recession. We're in a full-blown recession if oil hits $200 a barrel, if not a depression. I mean, let's be honest.
Yeah, that's true. It's all about duration, though, right, Brian? It's like how long does it spend at that elevated level? And you know, every time there's an oil price shock, someone wants to be the highest estimate.
Oh, they love this stuff, Art. Everybody's trying to be a hero. They always want to predict something. Why are we trying to predict $200 a barrel oil? Who the hell wants to see that?
Right. It's usually Goldman Sachs. So Citi beat them to the punch today, and they came out with a $200 price. And anybody can model that out, but it's knowing, as just said, it's knowing when we finally get more flow through the Strait of Hormuz, and if that is something that could physically happen, then you'll see a collapse very much like we saw yesterday, and probably retrace about a half of the move that we've already seen. So to the extent that anyone that wants to predict this is also going to have to tell you, what the weather's going to be like in a month. You just don't know until we start to get some constructive conversation going on about what it's going to take to open up the straits, because without that, there's, you could predict any price you want. It's just, it's impossible to have that come to fruition unless and until we know when we get some resolve on getting the straits open.
All right, Citi and Goldman, of course they can predict the weather, right? What are you talking about? I mean, they do it all the time. I put this to my guest yesterday. I want to put it to you. The market volatility is back on climb. We're seeing these wild swings, which is to be expected. How do you play this? Like, what do you do in a backdrop like this?
Yeah, three things to think about, Brian. And I think the first and foremost is that you don't want to listen to the sort of daily headline-driven markets and think that that's normal. I think what eventually happens is we get to a place where we have a better understanding of the duration of this conflict, and then things start to get back to a steady state, right? So there are those that will say that we haven't priced in enough of what this could possibly mean in the markets, and that's likely true at the index level for the S&P 500, where we're still not down 10% from recent highs, and at the VIX level where we haven't closed above 30 for 2 consecutive days. We've tested it, but we haven't closed above that. So the people that watch this in terms of when we get to that capitulation sell-off to making a decision that we've probably bottomed out, we're very early in that stage. But I think that it's all about your time frame too. If you're a long-term investor, you shouldn't be playing geopolitical events, right? So if you did the same thing at the beginning of any war, you've actually lost money because six to 9 months later, the market is typically higher. That was true when Russia invaded Ukraine 4 years ago. It's likely going to be true again. This is true about the markets going all the way back to World War II. So if you're a long-term investor, don't try to play geopolitical events, and certainly don't wait for all the dust to settle, because the dust never settles. There's going to be something else after this conflict that we'll be concerned about.
Good stuff there. Arnaz, let me get back to you here, because this has been a morning of interesting calls, at least in my email inbox. Another one that caught my attention, Bernstein on Bitcoin.
Bernstein is saying that Bitcoin looks like it's bottomed. That is one big call because you're seeing Bitcoin at around 70,000, 71,000 right now. But what they're saying is and they still have 150,000 price target, by the way, on Bitcoin. But they're saying, look, Bitcoin has outperformed. It has a stronger buyer base now. It has strategy, which is like the Bank of Last Reserve for Bitcoin. It is now you have long-term holders that are holding Bitcoin, and the retail hands that panic sold, well, now you have a stronger base. That's their thesis. There are other Wall Street analysts that are saying that Bitcoin has not bottomed yet, but Bernstein is saying it's going higher from here.
Speaking of going higher, I shout out top of the show, Art, that Google is still holding above its 200-day moving average. Like to see it, but the rest of the Mag 7 is not doing so great. What's the play there, you think?
Yeah, technology has been doing great since the fourth quarter of last year. There's been obviously all sorts of questions about artificial intelligence CapEx, the circularity of some of those contracts, when we'll see a return on invested capital. More importantly, of late, it's been, you're playing this artificial intelligence whack-a-mole. What sector or what business line is going to be destroyed because of AI, and taking out software companies one at a time and taking them to the woodshed. And I think all of that's been very overblown. I think that one thing to take a step back from is we started this war in Iran when technology was very oversold, and it has actually held up better. Energy's been the best performing sector. Technology's been the second best performing sector. I think there's a lot of reasons for that. I think technology has proven to be a bit immune to higher energy prices, and it comes into this event in a very oversold, the lowest multiples we've seen in about 4 years.
Art, real quick, you know what has also been immune? Earnings estimates for the S&P 500. Every chart that I look at, it looks like this. There you go. My hand's running off the screen. I mean, that's where all these estimates are still going. I mean, what point does the street mark down its estimates? I'm not talking about 2%, 3%. I'm talking about a large markdown because of higher oil prices that impacts the stock market.
Again, all has to do with duration. It's for how long are we in this elevated state? So if we start hearing first quarter earnings reporting and companies start talking about the impact of higher energy prices, understanding that only 1 month of this quarter was impacted in the first quarter. So I think that if this drags on into the summertime, you're certainly going to see downgrades, especially with energy-intensive industries, the industrials, the materials, et cetera. And we'll certainly see a continuation of the sell-off in things like consumer discretionary, especially as it pertains to travel and leisure.
That makes a lot more sense to me than that $200 oil shout-out. Art and Ez, thanks so much. Good to see you both, as always. For more Polymarket odds, you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub powered by Polymarket. I head here first thing each day to get the pulse of what could be hot or not in the markets, and you should be doing that too. Straight ahead, I am drilling deep into a U.S. economy that has been shocked to its core because of surging oil prices. Noted economist Noria Roubini is here with me next. The global economy has been shocked by the surge in oil prices at the hands of the U.S. war in Iran. This has sent investors off to try and determine how bad this will be for corporate profits and if interest rate cuts from the Federal Reserve are truly off the table for this year. Nouriel Roubini is a professor at NYU, and he joins me now. Always enjoy catching up with Nouriel. Nouriel, I've been saying for the past week, this surge in oil prices has been a shock to the U.S. economy, but we're not seeing that reflected yet in stock prices. Like, where's the disconnect here?
Well, the disconnect is that the markets are still believing that this is going to be a relatively short war. They'll end up in the next few weeks, in which case the impact of the rise in oil prices on inflation and on U.S. economic growth is going to be moderate. There'll be some slowdown in growth. There'll be some increase in inflation for a few months, but there's not going to be a significant de-anchoring of inflation and inflation expectation. Now, the market could be right, could be wrong, but let's put it this way. Historically, we're two extremes. One, 1970s Yom Kippur War between Israel and Arab state, tripling of oil prices, stagflation, recession, high inflation in 74, 75. Then we had the Islamic Revolution in Iran in 79, double deep recession, 80, 82. That was one extreme. High inflation, severe recession. The other extreme was June of last year, when the war lasted only 12 days. Oil prices went up, then went back again. Stock market wobbled for a few days. Same thing for bond yields, but then went back to normal. Today, it doesn't look yet like the 1970s, but it's something worse than the 12 days war of last June, when Iran was either unable or unwilling to block the Strait of Hormuz. This time around, the straits have been blocked. Some of the production facilities of the Gulf have been damaged, and therefore the impact on oil prices and potential on inflation and growth is going to be greater. How much greater depends on how long this war is going to last. The market are still expecting is not going to last much longer.
Do you think the economy will surprise folks to the downside in the first half of this year because of the war, how it's impacting consumer sentiment, and how it's also impacting their wallets? Now, I don't think we are, far be it for me to say this, but I don't think we are in a recession yet, but are we in a very, very slow growth and backdrop?
Well, there had been some slowdown of growth last year because of the impact of the tariff, but actually growth was beginning to accelerate this year because you had monetary easing, you had the fiscal stimulus still in the pipeline, financial conditions were very, very easy, and overall business confidence was strong, and you had still tailwinds from the AI and the data center and the capex boom. Those were the reason why actually growth should have become stronger this year compared to last year, while inflation would moderate as the impact of the tariff fades out. Compared to that baseline right now, the impact of the shock is some slowdown in economic growth, some increase in inflation. Again, if the war lasts only 2 months, there'll be the slowdown of growth and rise in inflation, but it's going to be moderate. And we could still grow faster than potential this year. And inflation is going to remain above target, but it's going to be okay. If instead the war lasts 3-4 months or longer, then the impact on growth will be stronger, negative impact, and the impact on inflation and inflation core and headline and expectation become higher. For now, the markets and the Fed are thinking this is going to not last very long. That's why the Fed is on hold. They're not going to cut rate because there's impact on inflation, but they're not going to raise rates. But if the war were to last longer and inflation expectation become de-anchored, then the Fed, instead of cutting rates, even a worse Fed will be forced to increase rates. And markets right now are starting to price not a cut by the Fed, not on hold, but actually the likelihood of an increase in the Fed funds rate is increasing because people are starting to worry that this war is going to last longer than initially expected. So markets are starting to price in a Fed hike rather than being on hold or a cut.
Nouriel, I've been getting a lot of forecasts recently from Wall Street on oil prices, and everyone I see, by and large, they expect oil prices to stay above $100 a barrel for the next few months, at least to the end of April. What's your biggest concern from an economic standpoint if that, in fact, happens? Is that the tipping point that gets us into a recession?
Not necessarily. I would say that if it stays above 100 until end of April, the impact on inflation is greater, and the impact on growth is also somehow greater, but it's not enough. If then after April we go back to oil, not like it was before, there'll be a risk premium, but 10, 15% higher, then there is, as I said, some slowdown of growth this year. There is some increase in inflation, but for now, a recession is not my baseline. By the way, the U.S. is a net oil and energy exporter. There are still distributional effects because the winners are oil producers and the losers are consumers of oil in the industrial sector and or among the household. But the U.S. is a strategic reserve. It can use fiscal policy to try to reduce the impact by reducing the federal taxes on gasoline. It could even tax the winner it distributes to those who are left behind, could restrict exports of LNG and oil to increase the supply at home. There is a gap between what's happening to Brent and what's happening to WTI. So compared to Europe and compared to Asia, the economic impact is going to be smaller for the United States because the terms of trade effect is positive on net for the economy.
Nouriel, you mentioned the Federal Reserve. How likely, can you assign a probability to the Fed actually hiking interest rates this year? This wasn't even remotely in the cards coming into this year. Everyone expected several rate cuts. That's been completely unwound. Like, how likely is that by the now assuming that the Kevin Warsh Fed later this year?
Well, my baseline is one of the Fed staying on hold and maybe towards the end of the year doing the one rate cut that was penciled in the SEP production of the dot plot of the Fed. Markets for a while thought there will be, two rate cuts. Now that's out of the question. I would say the baseline and the highest probability I assign is being on hold and maybe a rate cut towards the latter part of the year. A rate cut earlier, I think, is totally, highly unlikely. Even if the economy were to weaken significantly, if it weakens because inflation is higher, there is no argument for the Fed cutting rates. Even at the latest FOMC, even the doves like Diane Bowman and Chris Waller did not vote for a rate cut now. The only one was Steve Miran. And even if Warsh comes to power, it is not going to have a majority for cutting rates. So I would say 10% probability of a rate cut, not most, 60% probability of staying on hold through September, October, and maybe at this point a 30% probability that the war lasts too much and too long and oil prices are staying higher even beyond April, in which case then the Fed would hike rates by the middle of the year. Whether is Powell still there and Warsh is confirmed or not, it doesn't matter. If inflation expectation get anchored, the Fed will be forced to raise rates. But to me, it's a tail risk, a 30% scenario.
Do you think the Fed, Nouriel, just needs to get comfortable with this year being a year of a stagflationary economy?
Well, it depends on what we mean by stagflation. When there's a negative aggregate supply shock, growth is lower, inflation is higher. But there are three types of inflation higher. One is when you have a temporary increase in the price level and it fades away. The second one is when there is a permanent increase in the price level, but inflation expectations are not de-anchored. And third one is when there is a rise in inflation rate and inflation expectation. In the first two cases, the optimal response is to wait and see and stay on hold, not to cut rates, not to increase them. But if instead inflation expectation become de-anchored, a Fed is forced, or any central bank is forced to raise policy rates. Otherwise, you have a permanent increase in inflation expectation. So we don't know yet whether we're going to be in that third scenario. It depends on how long the war lasts and for how long oil prices are going to stay well above $100 per barrel.
Nouriel, I was thinking back to a conversation you and I had probably 2 years ago at Davos. It feels like yesterday. We were talking about AI at the time. I think you expressed some concern how AI will impact the economy. But since then, the AI rollout and development, it has gained serious speed. A lot of leaders that I talk to are now literally replacing thousands of human beings with AI agents. How concerned are you about the impact to the economy and the white-collar workforce?
Well, I've become an optimist in terms of potential growth. My view is that US and China are ahead in these 15 different sectors and technology of the future. It's not just AI, there are whole other industries that are related to AI that are separate verticals, and all of them are going to be benefiting from this productivity growth. So in my view, US potential growth by the end of the decade is going to be about 4%, a double of what is right now. And because of that, the inflation is going to be lower. So that's the fundamental that's going to occur over the next few years. So from that point of view, I'm optimistic. Now, initially, the demand for labor is going to increase, actually, rather than reduce, because you need to build all the data center and all the jobs that are related to AI and new AI firms and startups and you name it. In the long run, of course, you get a massive increase in productivity and you start to see job shedding, something we're already seeing right now among some of the more advanced big tech and Max 7 firms, but we're not seeing it yet at the, aggregate level. The weakness in the labor market has been driven more in the last year by supply of labor, because we have aging of population and we have restrictions to migration, rather than really a fall in demand driven by AI. And in the short term, the AI is going to increase the demand for labor. But over the medium long term, of course, there'll be massive amount of labor shedding. But we already have a mean-tested UBI system of progressive taxation, redistribute those left behind. And if growth goes from 2 to 4 and 10 years from now to 6 or 10% by 2050, that's a good problem to have, because with a 10% growth and say 80% unemployment, you can essentially tax the winner and redistribute and make everybody else better off, even if socially and politically that's going to be problematic. So long term, I'm an optimist, but in the short term, some of the stagflationary forces we worry about, including geopolitical conflict, deglobalization, and other things, may slow down growth and increase inflation, rather than the opposite coming from technology that is a positive aggregate supply shock, increasing growth and reducing inflation. So it's a tug of war between short-term stagflationary forces and a long-term secular boom driven by technology.
Nouriel, always so good to see you. Safe travels wherever you're headed. I appreciate you coming on.
Great seeing you.
Thank you.
Pleasure. Bye.
Opening Bid is known for big moments with top execs, and this week is no different. Tomorrow, the CEO of Zillow stops by as his company holds a closely watched New York City Investor Day with the 30-year mortgage rate back on the rise. This convo comes at an important moment for the U.S. housing market. Meanwhile, I have a special new podcast dropping on Thursday at 8 a.m. on Mercedes-Benz CEO. You will not want to miss this one, especially if you own a Mercedes, aspire to own one, or just love cars. Stick around. Much more ahead on Yahoo Finance.
All right, welcome to Market Catalyst on Yahoo Finance. We'll cut that part out. I'm Miles Sullivan, 30 minutes into the trading day here. Let's take a look at the major averages on this Tuesday morning. We got lower across the board. Yesterday we saw stocks open up about 2% and fade through the session, really closing right near session lows, continuing that grind lower, let's say, from the pop we saw to start the week. Really 7 o'clock yesterday morning, we got that post from President Trump about the 5-day cessation in hostilities in the Middle East, really coming in from those levels. Dow Jones Industrial Average down about 0.6, kind of uniform performance here among the majors. S&P 500, a slight outperformer, down 0.5%. So pretty standard market, let's say, lower, nothing super notable right now. We'll see how things shake out through the session. But again, feels to me at this point like we've got a 2-day extended move here of just slowly fading some of those headlines that we saw come into the market to begin the week. Let's stay on the markets, talk a little bit more about everything going on. Joining me now, Dave Mazza. He is the CEO at Round Hill Investments. He's here in studio, and Brent Schutte joins us. He is from Northwestern Mutual Wealth Management, CIO over there. Gentlemen, thanks for stopping by. Brent, I want to start with you and just kind of get your read on maybe like one number, one data point, one market that you and your team are looking at right now to kind of just ground yourselves, get a sense of what's the trend, what's the vibe out there, what's one thing that you can kind of point to and say, all right, let's stay focused here and we'll get a sense of what the next week, month looks like if we just watch this number.
I think it's all about interest rates. And so people are fixated on oil, which certainly is kind of the catalyst for rates moving higher. But where rates go in the future is going to determine how the economy shapes up and determine where the markets go. And that's where the real risk is, because the economy the past few years has been narrow. You've had the rate sensitive parts harmed versus the AI parts that weren't harmed. And that's where, if you think about it now, AI needs more debt to be brought to life. And that's where rising rates and tightening credit spreads potentially up in the economy overall.
Dave, it's interesting that Brent goes to rates, because the first question I wanted to ask you was about something you flagged, we discussed yesterday, which is PE multiple for the stock market has really compressed. And we're really seeing an interesting dynamic now where the underlying fundamentals of a lot of the biggest companies remain positive. But what investors want to pay for that has really come in over the course of this year.
Yeah, no, I think Brent's point on interest rates is certainly incredibly valid and a big driver of the moves we've seen in the last week. But if you take a step back and try to look at the signal through all of the headline noise that we're seeing today, is actually valuation multiples across the market, particularly for some of the mega cap names, the Magnificent Seven names, are much more attractive today than they were 6 months ago. Mm-hmm. Coupled with the fact that actually since this conflict started, we've actually seen earnings estimates across the market increase. So fundamentally, for now, the picture actually looks quite strong. So for investors kind of with a longer term outlook, even with all the uncertainty out there, it's certainly a more attractive entry point from my point of view than it was a few months ago.
Well, I guess to follow up on that quickly, so do you feel like an environment where we saw what the S&P peak at, 24, 26 kind of forward multiple. If we're down a couple turns today, do you still feel like investors are comfortable paying in that mid-20s, which is historically high, but had become historically normalized really over the last 5 or 10 years?
Well, that's the thing. If you look at longer term valuation multiples, we know this is not a cheap market, and I'd be hard pressed to try to convince everyone listening today that it is. But if you look at sort of recent history, it's certainly not on the higher end of where those multiples have traded. And one of the reasons why the market has traded at higher multiples today than it has historically is simply the fact that companies are more profitable and generating more revenue. Now, it's been incredibly bifurcated of where that revenue is coming from. It's been coming from a concentrated portion of the market generals, the Magnificent Seven, less so in kind of the real economy stocks. And so when investors then kind of try to parse all that through together, especially looking at sort of an incredible amount of uncertainty and question marks compared to the rhetoric and what's actually happening potentially on the ground in the Middle East. Yeah. I think that's one of the reasons why investors are probably not necessarily buying the dip as we've seen every other time before.
And, Brent, another factor around why investors aren't buying the dip is what we're seeing or not seeing or can't really count on when it comes to the Federal Reserve. Now, last week we heard from Jay Powell. I think his comments were a little bit of a surprise to market, how sanguine, in my view at least, he seemed as it relates to inflation. It also just feels there, Brent, like structurally there's a lot of uncertainty about what this Fed even looks like in 3 or 6 months' time.
Yeah, I agree. There's a lot of uncertainty about what the Fed does and what they may not do. I think they're missing on both sides of their mandate, and that's the big risk right now. Inflation hasn't been at their 2% target for 5 years now. And we have made no progress the last 2 years. Inflation is the same today as it was at the end of 2023 based upon PCE on a year-over-year basis, and it's probably going higher this month. On the other side, the labor market is weak. I think Chair Powell called it an uncomfortable balance. And that's where I just think right now you have a lot of uncertainty about which way monetary policy goes. I've called the economy a delicate balance. I think monetary policy is a delicate balance. And this is where I encourage people, back to what the other guest said, to think about valuation. Mm-hmm. I don't think the S&P 500 is cheap. This is where, if you're thinking longer term, small and mid cap stocks traded the same valuation discount they did to large cap back in 1999, a very similar time period. And I encourage people to think outside of that S&P 500, which is everyone's favorite because it's done well the past few years. This is where we saw broadening before the conflict. And even today, as the conflict kind of still continues, small and mid cap stocks have not deviated or gone down much more than their large cap counterparts. I think this continues into the future, and that's why I would encourage people to think about investing.
So then, Brent, I guess coming into this year, something we discussed a lot on this program is we had a lot of investors come through and say geographic diversification really was a reminder. 2025 was a reminder. This needs to be part of portfolios. You're talking a little bit there about kind of size diversification. Does it feel to you like the conflict has in some ways merely accelerated trends that we were already seeing on where investors want to be positioned?
I don't know. I mean, I guess to me, I think about geographic diversification as being more international. I think that's what you're referencing. And certainly the past year, the dollar has been a tailwind because the dollar faltered. So U.S. dollar-based investors had their returns accentuated. This year, certainly the conflict impacts overseas much more than it does the U.S., given their dependence on oil that moves to the Strait. And the dollar's moved higher. I do think longer term, the dollar's direction is still lower. And that's why I would encourage people, despite the conflicts and the risks that are out there, to think about international diversification, because I do think if the dollar falters just a bit, not a comment that it won't be the reserve currency, that's where I think you'll continue to get some of those accentuated returns in the future.
And then, Dave, last one to you. Just thinking about some of the dynamics we've seen specifically as it relates to the AI trade this year. You referenced the Mag 7. Those were the winners of the first, let's say, phase and a half of the AI trade. And we've seen, companies like a SanDisk, right? Western Digital, Micron. These stocks, they feel like they kind of go up every day. You've also seen losers on the software side. How are you thinking about the way that this trade plays out now against a pretty dynamic, geopolitical background, which maybe you say isn't central to the AI trade, but it weighs on sentiment. Do you feel like that's an accelerant? Does it not matter? And how do you see, AI over the balance of 26?
Well, it's interesting. I think to your point, sort of in phase one of the AI trade, it was quite easy. You'd buy NVIDIA and you actually did quite well. Then maybe phase 1.5, to use your term, was then brought out to the hyperscalers.
Yeah.
Those that were
Meta, yeah.
Yeah, exactly. Those that were investing in data centers and sort of building the framework for AI. Now it's changed where investors are now parsing through to what I kind of call the invisible winners, although based off of their stock performance, they become much more visible. Those are your memory and storage stocks. So companies like Micron, Asian companies like SanDisk, SJ Hynix, and now some of these storage names that have been around for some time but have been forgotten about. SanDisk is, I think, the prime example of that, let alone Western Digital and others. But actually, there's a reason why they're doing quite well. Is in order for all this spending to actually work, you can't just have a GPU as powerful as it is, or many of them, unless you have the memory chips to sort of make them work, and then the storage chips to actually store all that data at the back end. So we think the AI trade is still, we're very bullish on it longer term structurally, but investors do need to be comfortable with the fact that actually it's evolving quite rapidly, and it's not necessarily going to be an either or anymore.
All right, appreciate the time. Dave Mazza, Brent Schutte, thanks for stopping by on this Tuesday morning. All right, coming up here on Yahoo Finance, we'll have all the latest from CERAWeek down in Houston. You're watching Market Catalysts.
Welcome back. I'm Julie Hyman here at the CERAWeek by S&P Global Conference in Houston, Texas, where, as you might imagine, the Iran war is top of mind for almost everyone here and the effect on global prices, oil prices, and the global economies. I'm here with Paul Grunwald. He is S&P Global Ratings Global Chief Economist. So obviously you're paying a lot of attention to this also, Paul. We got S&P PMIs this morning, which is a measure, a survey of what's going on, how people are feeling about the economy. We saw that at the lowest in almost a year.
Right.
How are you thinking? What's your latest thinking about the effect that all of this is going to have on the economy?
Right. Well, first of all, this is a supply shock, not a demand shock, right? In a demand shock, activity drives up prices. In a supply shock, the high prices drive down activity. So we're looking for evidence that activity is slowing. The PMIs are a great example of the soft data. We expect the soft data to weaken, and then we're going to get the official hard data later. But we had weaker US this morning, we had weaker Europe overnight. So we're starting to see the first evidence of that. But I think the direction of travel is pretty clear until we get all of this sorted out.
Okay, so you're looking at what's going on in sort of phases. So you talked about the supply shock. There's a sort of, you talked about a flow shock, a supply shock.
And then the market shock.
And then the market shock.
Okay, so yeah, our energy guys who are sponsoring this conference, they've got a 3 kind of phase model. The first phase is the flow shock. That's the shutting of the strait. We know that ships are trapped on both sides. Those oil deliveries are kind of reaching their ports now, and you can kind of manage that through inventories. If we were to end this now, we would get a temporary bump in prices and maybe a little bit of weakness in growth, but it would sort itself out. We're now going to the supply shock where, you know, some countries won't be able to get the oil they need except at very expensive prices. If you're a producer like the US, you're probably reasonably insulated. A lot of stocks like China and Japan, Korea, you're reasonably insulated. But now we're focusing on which countries are not producers, they don't have the stocks. The focus seems to be on South Asia and some of the global South. Those Brent and WTI indices or benchmarks, you know, they're showing global sort of benchmark prices. Some of the spot prices locally are much higher than that, but that's the next stress point.
Well, and there's been a lot of talk about, Mike Wirth of Chevron talked about this yesterday on stage here, the difference between those physical spot prices, what people are actually paying to get the oil itself, and what's going on in the futures market and out the curve, which is showing some optimism going forward. And he said maybe that's going to change. And that's a theme I've been hearing repeatedly here from you, from your colleagues, from other folks at the conference, that maybe the markets are a little too optimistic about this ending quickly.
Yeah, that's definitely a narrative here. I think there's a tension. This conference is mostly engineers, and if you go to like the IMF World Bank, those are mostly finance people. And as our oil guys like to say, oil's not like a faucet. You can't just turn it on and off back on. So there's lags of bringing production back on. And, you know, I think there's a lot more caution on the physical side of bringing this back up quickly, even if we get a resolution. And we're going to try to reflect that in some of my team's forecasts that are coming out this week. But that's definitely a risk we need to take into account. Even if we can manage to resolve this, it's going to take weeks, if not months, to get the production back up and sort out getting the production up, getting the ships in the right places, et cetera. So this is not just flipping the switch and we're back to, you know, pre-Iran conflict macro.
So how dire or how high is the risk of recession then?
We would need the final phase. We talked about those 2 phases, the flow phase, the supply phase, then there's the market phase. So again, if we go back to what we just discussed, we've got the engineers and the supply guys, the industry guys saying one thing, the market says the other thing. one of those views is wrong.
Right.
And if the market reprices this whole scenario, right, you get a sell-off, market prices drop, spreads blow out, capital stops flowing to emerging markets, we get the flight to quality, people stop spending, and then we get into sort of a global recession scenario. That's the hard downside, that's kind of a narrative scenario right now, but if we don't resolve this and this goes on for months, that is going to become a more likely scenario.
Okay, so how are you sort of gaming it out? Are you and your team saying, okay, if this lasts 1 month, here's what it looks like. If it lasts 2 more months, here's what it, is
kind
that
of roughly. I mean, I
it?
think that's not that sequence is not an exact linear order, but I think that's roughly where we are on the narrative. So for right now, we've got a sort of conservative baseline. It's probably close to financial consensus, but we are definitely flagging that if this goes on and we go into this supply phase and then into the market phase, things could get worse. So we're on a sort of a scenario now where the baseline probability is shrinking a bit, and we're putting more weight on the downside. And if we need to go there, we will change if that's where the market goes.
So the other question that is now really bubbling into the market is what the Fed is going to do. What is going to be the prolonged effect on inflation, if there is going to be any?
Yeah.
And is there a chance that the Fed will actually have to raise rates?
Right.
What do you think?
So we're putting out a forecast tomorrow, so I will give you some directional guidance and some narrative. But I think the sort of the rate cutting narrative is pretty much off the table for 2 reasons. One, although energy is not a core part of the price index, it will seep into the core through airline prices, restaurant prices, transport prices, et cetera. So inflation is going to go up at the headline level and the core level. We want to make sure inflation expectations are anchored. We know that central banks were a bit late to get going in 23 and 24. So we're dialing back the Fed narrative. The ECB has been pretty clear. Christine Lagarde's already saying that we're very cognizant that last time we were late to go. So now the market's got the ECB's next move is up. The Fed's a much closer call, but I think this whole narrative that we were late in the cut, we were sort of toward the mature part of the cutting cycle, a few more to go. I think central banks are very much on wait and see mode right now, and a lot of cuts we had put into the forecast are now being taken off.
Paul, I also got to ask you a question that's a little more personal to us, I guess, and immediate to us, and that's our travel plans.
Yes.
To get out of Houston, because as you know, with the TSA not being funded, a lot of people are out. And the main Houston airport is viewed as one of the worst airports for wait times in the country. So I'm curious if there's any sort of economic impact from all of this that you're thinking about.
There's sort of the hassle element now, but
like, do people decide they're not going to travel?
Well, that's the thing, right?
If
flights are more expensive and the fuel gets passed on to airport prices, and then you can't get to the airport, I mean, that's a decent chunk of the U.S. economy. Maybe it's more of a sectoral story. So if you're a sectoral airline analyst, your fuel is more expensive, your passengers aren't showing up at the airport. That could be a downside risk to those guys. But yeah, this is showing up in all kinds of places that we haven't seen, and it's our job and others' job to sort of make sense of all of it, track it out, and look at where we're going and flag the risks, and that's kind of where we are.
What day are you going home?
I'm going to visit my mom in Oklahoma on Friday, so I've got a short trip, and then I'll go back to New York.
Okay, well maybe things will.
You're leaving tomorrow, my friend.
I'm leaving today.
You might be in a little bit more risky situation than I am.
Yeah. I'm building in a lot of time. We'll see.
All
how
right.
it goes.
Well, good luck.
Thank you. Good to see you, Paul. Thanks
Likewise.
so much. Miles, back to you.
All right, Julie. Maybe I will see you tomorrow. Maybe. Well, you let me know as the day goes on. All right, coming up, we're going to take a look at some of today's trending tickers. Stay tuned. You're watching Market Catalyst. right, time now for some of today's trending tickers. We are watching Jefferies, Estee Lauder, and Tesla. First up, Jefferies stock trading higher after a report from the Financial Times said that Japan's SMFG was weighing a buyout of the investment bank. Now, a later report from Bloomberg said SMFG, Japan's second largest lender, has no immediate plans to take over Jefferies. And CNBC, citing sources, later reported that Jefferies has no interest in selling the firm. The company is set to report its quarterly results on Wednesday, March 25th. Next up, Estee Lauder in talks to merge with Spanish beauty company Puig. Puig is a family-controlled company and owns popular brands like Byredo and Charlotte Tilbury. The merger would create a cosmetics giant with a combined market cap of about $40 billion. The talks are continuing, and there is no guarantee that the companies will reach a deal. And finally, Tesla seeing a sales rebound in Europe. The EV maker's European sales rising nearly 12% year over year in February. It marks the first time the company's European sales have risen on an annual basis since late 2024. Gold prices now below $4,500 per ounce despite the uncertainty around the conflict in Iran. Yahoo Finance's Josh Lipton spoke to Max Baker, American Hartford Gold president, about the latest moves.
You point out here, Max, gold, we broke below this key support and the 50-day. What do we make of this, Max? How do we explain it? Why isn't gold acting more like your classic safe haven right now?
A great question. Everyone, expected gold to rise with the war kicking off, and obviously it's fallen quite a bit, about $1,000 off the all-time high here, and it's really has to do with the oil. You see oil go up above $100 a barrel. That really gets in people's head that now the Fed's thinking about pausing or maybe even raising interest rates to fight future inflation. So it's really an oil story right now. And, until we can get oil prices to come down, those interest rate cuts are going to be off the table, and that dollar is going to continue to rise.
You put it like this on the gold market, Max. You're so tactically nervous, but still structurally long-term bullish. Why still structurally long-term bullish on the metal?
Yeah, this is kind of a short-term move, but all the fundamentals are in place that, caused a 70% rally in gold last year. You still have central banks buying up gold at record pace. You have record debt, record money printing, and there are still many that expect interest rate cuts at the end of this year with Warsh taking over in May, or suspected to take over in May. So all the fundamentals are still very much in place for a healthy gold price.
What would you need to see, Mac, to say, okay, maybe that structural long-term thesis is at risk here? What would be on your radar to watch?
Yeah, I think you need to see inflation really rise, 4, 5, 6%. I think you need to see the government get money printing under control, our debt situation under control. And those are some things that I just don't see happening.
Max, in terms of levels you're watching here closely, you say 4,900 to 5,000, that range. Why that range, Max? What about those levels?
Yeah, I think, that's kind of where we need to be right now to show, that gold has staying power. You've got a lot of major banks out there that are predicting gold to be at 6,200. You got UBS saying 6,200, JP Morgan, Wells Fargo saying 6,300. So, if we can get above the $5,000 level, I think that will kind of ease some investors' nerves here going into the summer.
So, Max, let's kind of bottom line this for a viewer. Let's say I'm watching this, I'm a long-term investor. Do you say, hey, right now I would say kind of cautious, or no? Do you argue this is a good moment to step in?
I think this is a great buying opportunity. Obviously, I'm in the gold business, but, we've got a lot of clients that have been waiting for a pullback, an opportunity to get into metals. Obviously, we had silver up 140% last year, gold up 70% last year. It needed to kind of cool off a little bit. I think this is a great entry point with fundamentals still very much in place.
So you're in the gold business, you said there, Max. What is the price where we are right now, Max? What does that imply about potential gold miners' profitability over the next few quarters?
Yeah, it's a great question. Every gold miner is a little different. Every company basically has a price that it costs them to get the metal out of the ground. And it varies based on each operation, but that could be anywhere from $1,700 to $3,000 an ounce. But each company has that set price that it costs them to get it out of the ground, and obviously the higher the gold price, the more profitable they are, the higher margin they have.
Final question, Max. We've been talking gold. What about silver? I'm just curious to get your thoughts on silver, both now and ahead. What do you see?
Yeah, we're about $50 off the all-time high, which is just a few months ago. So, if you're looking for an entry point or looking for something that's cheap, relatively speaking to where we were a few months ago, I do think silver is wildly undervalued. Obviously, we had the big rise, 140% last year. Had a lot to do with China saying they're no longer going to sell their silver. They produce 70% of the world's silver. So I think silver is a great value buy right now.
Max, great to have you on the show today. Appreciate it.
Yeah, thank you so much.
All right, coming up, we're going to talk to Caterpillar's head of power and how AI demand is fueling that business. You're watching Market Catalyst here on Yahoo Finance.
Welcome back. I'm Julie Hyman here at the CERAWeek by S&P Global Conference. And as we've been talking a lot about this week, we're sort of focused on two main factors. One, the Iran war and the reshaping of the global energy markets. And two, the vast need for power right now, particularly because of AI and data centers, but also just a general need for increasing power. I'm joined by Jason Kaiser. He's Caterpillar Group President of Power and Energy. So a lot to say about these various topics, and really appreciate you joining us.
Yeah, great to be here. Thank you.
So I do want to start with the war, because there are a lot of ripple effects on a lot of different kinds of businesses. And I'm wondering, you guys do have some business in the Mideast, in the oil and gas sphere and elsewhere. What have you been seeing there? Have you had to move your people around? Talk us through that effect.
Yeah, I mean, our priority has been on our employee safety up to this point. So lots of efforts there to keep people safe. We have people throughout the region. From a customer standpoint, business in oil and gas as well, it's a little bit of wait and see with the customers. So we're not sure, they're not sure how it's all going to play out, but we want to be there to help serve them as we understand, as it becomes more clear.
And what about like the servicing that you would do in that region? Is that still going on? I imagine those are long-term contracts, so they're not necessarily affected by the short-term what's going on, but what are you seeing there?
Yeah, I mean, we do service the equipment. We're there to take care of it, keep it up, running and reliable. We're putting safety first as we make those decisions and making them with our customers, but there's definitely a priority there on helping the customers continue to be successful as they make the decisions on whether they run or not as well. So.
On the flip side, I've been hearing a little bit of talk here that what's happening in the Strait of Hormuz and the choking off of oil supplies and energy supplies there is sort of reinforcing the need for energy security. And I wonder if you're hearing that from clients, if they were considering a project that is not going to be reliant on those types of fuel inputs, if now they're sort of doubly convinced, or if that's helping you as you make your pitch to clients.
Yeah, I think it's a little bit early to know how that's all going to play out over time. We play a key role across the value stream. So we serve oil and gas customers all the way from bringing the product up through the ground, moving it through pipelines, and then burning it to make power. So we're getting a lot of inputs right now. We think ultimately that's going to be a very important part of it. How do we have not only more power, but reliable power over time? It's a big part of what we do, is ensuring that happens with our customers.
Speaking of it being early, I'm also curious if you're hearing anything from your clients domestically in the U.S. about increasing their production, and increasing orders from you in order to make that oil and gas production happen.
Yeah, I mean, we're in a very good market when it comes to oil and gas, even before the war and the situation. So we see that trend continuing. Gas compression's been a real highlight for us. Our customers are pulling for more product to help move the gas that's going to be needed for LNG. It's going to be needed to create more electricity with the moving kind of electricity market that we're seeing.
I'm also curious on the cost side for you guys. You're already facing increased costs from tariffs, right? $800 million, I believe, is the total cost from tariffs in the first quarter. Are you now seeing increasing costs as well because of some of the supply constraints that are happening with the Strait?
Yeah, we're working to understand the cost and the supply chain, kind of a daily activity right now. No huge impacts that we're talking about so far, but we'll continue to understand, continue to look at it closely.
Copy. Okay, let's talk more about the data center picture for you guys. We were just talking in the break about a panel that you were on yesterday where you were with the CEO of Duke Energy and talking about some of your partnerships there. Power really seems to be the bottleneck when it comes to these AI data centers. So where do you see us on that spectrum of kind of breaking up that bottleneck and making it happen?
Yeah, it absolutely is. I mean, as we talk to data, and I've worked with data center customers for a number of years, our business historically was a lot of backup power for the data centers. We've seen that change in the last year or so, where they're asking us for different kinds of primary power because they can't hook up to the utility. And in that case, sometimes it's a bridge, so help us for a short period of time to bridge the power until the utility can be ready, and we have products on wheels we can bring up quickly and make that a solution. Other times it's more of a midterm solution they want us to deliver, and sometimes now they're asking us just to build a power plant with them, behind the meter and
at the site of the data center.
At the site of the data center and be the primary power source for the foreseeable future. So we're excited about that. It's been great for us, and we have a lot of great solutions to serve that, no matter which of those solutions they're looking for.
And you guys have been booking a lot of orders on this front. I think it's 4 orders of at least a gigawatt each, if I have that right. And so you guys are doubling your turbine capacity in order to meet that. So we talked about what the bottleneck is for them. I'm curious where the constraints are for you, because if you're doubling capacity, are you finding the labor that you need? Are you finding the materials you need? Talk me through that process.
Yeah, we are doubling our large engine capacity, and we're more than doubling our turbine capacity between now and the end of the decade. So lots of work there. We're heavy in execution mode. Some of it's within our own facilities, upgrading equipment, adding new equipment within our facilities to be able to build more, but a lot of it's in the supply base. So we're out with suppliers, understanding what their bottlenecks are, working with them to invest to get the parts and the components that we need to build more products. So working it on multiple fronts, but having a lot of success so far. It's going really well.
And yours is the fastest growing part. It's now the largest part of Caterpillar's business. People who think of Caterpillar as a sort of earth moving company, right?
Yes.
You guys are really now a power and energy equipment company. That's the biggest part of the business, the fastest growing part of the business. So how do you see, further leveraging that growth up over the next couple of years? Is it just that the demand is out there and it's just a matter of meeting that demand?
Yeah, I think it speaks really well to Caterpillar and the diversity of Caterpillar and all the things that we're able to do across the machine business and now our power and energy business that we have. A lot of it's execution in our space. So we've set the targets with capacity. We've set some bold growth goals in our investor day last fall, and we're head down and executing. We see the demand there, not just power generation, but also strong in oil and gas compression. And so serving customers, having the right products, having the right solutions, taking care of them through the full life cycle with them is what we're focused on.
I'm curious, as I've talked to people at this conference, there has been this sentiment among the oil and gas folks that maybe the market is underpricing the potential duration of this conflict at this point. And then just was talking to an economist, if it does last longer, then you talk about more economic concerns and the slowdown potentially. Do you think that things like AI contracts are somewhat recession-proof? Or how do you think about that sort of economic sensitivity in your business?
Yeah, it's one of the great reasons to be here at the conference, because you get so many different viewpoints on that. I was on a panel group around AI this morning. Definitely positivity in that space and in the AI space that doesn't seem to be waning as I'm out talking with customers or talking to colleagues here this week. So we remain positive there.
All right, Jason, thank you so much. Really appreciate your time here.
Appreciate it. Thank you.
Miles, sending it back to you.
All right, Julie Hyman, live from CERAWeek down in Houston. Appreciate that interview. Coming up, we're going to talk about how ad-supported streaming platform Tubi plans to survive the AI age and the argument for why it's one of the most innovative companies of the year. All right, Fast Company out with its picks for the most innovative companies of the year. Tech giants like NVIDIA, Google, and Anthropic topping the list. Also included culture makers like Tubi, Nintendo, and Reddit. And joining me now to break down what went into putting this issue together, we're joined by Brendan Vaughn. He is Fast Company's editor-in-chief, also joined by Anjali Sood, Tubi's CEO. Brendan, I want to start with you just on some of the top names here. We'll maybe go through the top 5 and kind of how your team thought about putting this list together over the balance of 2025, I guess it was.
Yeah, so Miles, thanks for having me. Most innovative companies, it's our biggest thing we do all year. It is our franchise program. It is a year-round reporting project. Crunch time is in the fall, into the early winter when we publish this, but we're working on this all the time. Innovation is our editorial North Star at Fast Company, and we have 5 covers this year. They're not the top 5, but the covers are Google CEO Sundar Pichai, Anjali Sood, who's here with us today, CEO of Tubi, Alex Cooper from the Call Her Daddy podcast and Unwell, and Steve Huffman from Reddit, and Ryan Coogler, director of Sinners and the CEO of Proximity Media. So it's diverse. That's the whole point. It's a diverse across industry. It is our sort of core idea at Fast Company is that when you come to read us, you are getting ideas from across the entire innovation ecosystem, not just your own industry. And very often those ideas apply to your work, even if you wouldn't necessarily encounter those ideas in the course of your normal sort of industry media diet or in the course of your work.
Yeah, we were chatting before, and it's like I love a good list, and I love a list that goes AMD, Redwood Materials, Tubi, and then it goes to BYD.
And the Onion. The Onion's
exactly,
in there.
the Onion is in there as well. Anjali, I want to talk a little bit about Tubi and in this media moment where we have seen, I think, in my opinion, a lot of what Tubi's strategy it's kind of come to you guys. If I look at the way all these different media companies have hacked up their production, their rights, how they want to charge people for it, I feel like Tubi's value there as willing to take lots of content, willing to be ad-supported, has met the consumer in a place a lot of companies have moved out of.
Yeah, I mean, look, I think it was a contrarian bet at one point to say that the future of entertainment is free and on demand and is personalized and driven by choice. But yeah, I think in the last couple of years, we just see audiences more and more like this is what they want. And by giving them what they want, you can build a really thriving business. And I think being recognized by Fast Company is a great sort of validation that it's resonating with consumers.
So when you look at your catalog, what are the things that consumers are is it movies mostly? Is it old TV shows? Like, how is it breaking down in terms of those viewership trends?
Well, I think what's interesting is it's everything. We have some of the best of Hollywood movies. We have hundreds of Tubi originals. We have creator content. Some of the world's most popular creators are now putting their content on Tubi. We just announced a partnership with TikTok to help short form creators add long form. We have video podcasters. We have live sports. And I think it really does come down to this bet that if you think about entertainment, we no longer define that as just kind of Hollywood or television or movies. It's anything we choose to spend our time on. And that means for this next generation, we're competing with any other form of entertainment. So we have to make it as easy for them to access it.
Yes, I like to think that, we do this show linearly, we write stories linearly, but this will be consumed in kind of like interstitial time. Like it exists like in a vacuum, and filling the vacuum right now is mostly AI around text and content. And I'm curious how you and your team have started to think about AI content creation. Are you scared of it? Are you okay with it? And what are creators telling you about how they want to incorporate it?
I mean, I think for us, we believe in long-form storytelling. That's the content we put out. And actually what we hear from Gen Z, Gen Alpha, they want cinematic long-form storytelling. They also want the short stuff, but storytelling isn't going away. And so I think for us, what we are seeing from creators is many are experimenting with AI tools to help them make content faster, increase the quality and the production value of that content. And so I think we hope that this will be a tailwind. And if you just think about it, if there's a lot more content that's going to be made, every single one of those stories needs to find its audience and its fans, and that's the role I think Tubi hopes to play.
One of the things that I really found insightful and interesting about our interview, Anjali, I interviewed Anjali for the issue, was what you said about not following the herd, kind of, and it speaks to, Miles, what you sort of said in your intro about the world was everything feels like it's hitting your credit card and there's a subscription fee, right?
That's right.
Tubi
and I forgot about it.
Is free. Right, exactly. And you forget about there's apps to actually get that under control for people. But was just how much noise there is about like, oh, we're doing this cool thing, we're doing that cool thing. Oh, we better do that now, right? We have to keep up. Whereas the way that Tubi has been run under Anjali's leadership is, no, we're going to do what we think is right for our audience. We're going to follow that signal, and we're going to make something that is kind of this cross between sort of a TikTok style For You page, interface and a traditional fast network, and then throw in a little bit of traditional paid streamer in there too with all the premium content that you guys have.
Yeah, I'm curious, like in that context, Anjali, how you think about, the old Reed Hastings, like we're competing with sleep, and Netflix now has or Nielsen has the circle chart, and Netflix does it as well of time spent on all these different services, and Tubi's really started to show up in some of those places. Like when you think about form factor, I'm always surprised by how much YouTube is now being watched on televisions. And Tubi certainly, to me, feels like it lives on televisions, but is this now like a cross-platform? Like I'm on the commute, I'm on NJ Transit, and it's just people watching shows on their phone. I guess it all kind of feels like it's merging to one screen in a way. And that, to me, feels advantageous too. I don't know how you think about that.
Yeah, I mean, look, our job is to meet the audience wherever they are, and that definitely includes not just the living room where we are predominantly, but it includes mobile, it includes any surface. Mm-hmm. And we are doing a lot. We did introduce a TikTok-like feed in our mobile app, for example, because we know that people discover differently when they're on their commute. And we do think we can offer a really great experience throughout that. If you think about just what's happening in the entertainment industry, there is a lot of a tendency towards gatekeeping and walled gardens, mm-hmm. and the more we can just provide that ubiquitous access and just make it easy. Yeah. Just make it easy. How many of us have had a frustrating experience with finding what to watch or finding the sports show, game you want? We just got to make it easier. And it sounds like a radically simple idea, but it would appear it's innovative in today's world.
Yes, exactly. I want to turn my TV on. I don't want to load the TV, right? And then do the software, all the stuff. Quickly before we go, what are you watching right now?
Well, we have a very exciting Tubi original that dropped called Kissing is the Easy Part. Okay. I'm a rom-com girl, so I'm a big fan, and actually we've had a lot of success with finding some of these sort of young adult stories, and we'll cast TikTok influencers and digitally native talent in these movies. And I will say, I'm not just saying it because I'm the CEO, it is really good. Check it out.
That's great. All right, Anjali, Brendan, thank you guys so much for stopping by. All right, that's it for Market Catalyst. I'm Miles Udman. Thanks for watching. We'll have more on Yahoo Finance coming up after this.